we've had a great 2023 and an exceptional 2024 for clients, here at Wellington Altus. And we get a lot of questions about the market, where we're at today on the back of those 2 good years. Is the market overvalued? Is it undervalued? Is it fairly valued? I know that's a broad question, but certain sectors have, gone on a real run, like, AI and tech. Just wanted to get your views on where you see things at, and what factors you're using to influence your perspective on valuations right now.
Right. So I think the answer is there are parts of the market that are overvalued and there's parts of the market that are undervalued. And so there's a wide gap there, I'd say. Now, when you look at what's happened over the past 10, 15 years, we've been in a falling interest rate environment. It's been very supportive for valuations in the market. What we've been in has been a fantastic environment for passive investors. It's been a trending market. It's been an environment where everyone's made a lot of money. But when you look at especially the US market, it's become very crowded and concentrated in a number of expensive growth areas of the market that I think have disconnected from fundamentals. And we've been highlighting this risk for some time. So, our view is you need to be careful about investing in that part of the market. And quite frankly, even investing in the broader market itself, because it is so concentrated in a few companies that have been driving the performance of the overall market. But underneath those names, there are a bunch of opportunities that are very reasonably valued or cheap. And I think that's the hunting ground for investors like ourselves. We can find a lot of great businesses that are trading at very reasonable valuations, if not cheap valuations, that you can take advantage of. So I think the quick answer is, when you look at the broader market, it looks expensive. It is expensive versus history, but that's because it's concentrated in very few companies, and those companies happen to be expensive. But you don't need to invest in those companies as an active manager like us. You can invest in all these other opportunities where you can find value in reasonably priced stocks. And I think when you look back at history, after you leave a passive-led environment and go into more of an active stock picking environment, it's not unusual for the broader market to struggle. But that provides an opportunity for stock pickers to thrive. And you can see, even on a year-to-date basis, the broader market has struggled, and in fact is down. But there's a number of managers in different areas of the world that are doing quite well right now that you can take advantage of. So I think that's the environment that we're going forward. I'd be very careful about just investing in the broader market without having some diversification and picking individual stocks, because we're moving into an environment, in our view, that's going to be very favorable to a good stock picker.